Well, greetings everyone. Kia orana, tātou katoa, tēnā koutou katoa. Welcome to Te Pūtea Mātua, the Reserve Bank of New Zealand, and we're here with regards to our monetary policy statement that went live at 2 p.m. today. Before I start, I just want to thank the Monetary Policy Committee, all of whom are here today. Caroline, Peter, Paul with us, Christian in the front row, and on stage with me I have Karen Silk, Paul Conway and Adam Richardson, all who have been involved in the making of this fine document that we're about to talk to today. As is well known, the Monetary Policy Committee today increased the official cash rate to 3%, that's up from 2.5%. The committee agreed it remains appropriate to continue to tighten monetary conditions at pace so as to maintain price stability and contribute to maximum sustainable employment. Without doubt, core consumer price inflation remains too high and labour resources are scarce. Global consumer price inflation has continued to rise, albeit with some recent reprieve from lower global oil prices. The war in Ukraine continues to underpin high commodity prices, with global production costs and constraints further exacerbated by the ongoing COVID-19 health challenges internationally. The outlook for global growth does continue to weaken, reflecting the ongoing tightening we're seeing globally by central banks in their monetary conditions. Here in New Zealand, domestic spending has remained resilient to all of these global pressures and the local headwinds to date. Spending levels have been supported by a robust employment level, continued fiscal support, and elevated terms of trade and sound household balance sheets in aggregate. However, production is being constrained by these acute labour shortages. This has, of course, been heightened by seasonal illnesses, both COVID-19 and the influenza. In these circumstances, spending and investment continues to outstrip New Zealand's supply capacity, and wage pressures are heightened. A range of indicators highlight this very broad-based pricing pressure in the economy. Committee members agreed that monetary conditions need to continue to tighten until they are confident that there is sufficient restraint on spending to bring inflation back to within the 1 to 3% target range. The committee remains absolutely resolute about achieving our monetary policy remit. Thank you very much, and I invite questions.
Hi, Ainsley Thompson from Bloomberg. You're saying that consumer spending is remaining resilient. When do you foresee that slowing down, or do you foresee that slowing down?
Yes, so through our projection period ahead, whilst we do not forecast at all a recession, a technical 2 negative quarters, we do forecast low GDP growth, below potential growth rate, and a big part of that is slow, flat, real consumer spending. So, throughout the forecast, a notable feature is subdued consumer spending.
How concerned are you by the fact that a lot of retail rates have in fact been coming down a little bit, heading in the opposite direction from what you're going, and will that last? Not concerned. This is all about pricing. I might pass over to Karen. Do you want to chat around what you're seeing?
Yes, certainly some fixed rates have eased since July. The earlier peak that we had in part reflected higher volatility in global rates passing through into the New Zealand wholesale markets. But more recently, we've seen some of the more recent declines may actually reflect increasing competitive pressure amongst the commercial banks, with a slowing in credit growth through over the past 6 weeks or so.
So an important feature always to remember is that we can control the short end of the yield curve. The longer end is influenced by us and many other factors. And, on a positive note, perhaps markets are trying to pick future lower inflation.
But will you get on top of it, do you think?
We are adamant that we're in a very strong position to be on top of inflation. As you can see from our projections, we have inflation down back within the target range over the 18-month period, and it's all slowing inflation from here. So the hardest part to get on top of is not the noise related to the international price pressures, but it's that broad-based domestic pressures, and hence that's what we're doing with interest rates. So confident, a bit more work to do as we highlighted today, but confident.
Alexa Cook from TV3. I just wondered, how long do you expect inflation to remain this high? I realise you've pretty much answered that, but...
Yeah, so we see inflation declining, the growth rate of inflation declining from here. By the end of next year, it's just above our remit range of 3%, and soon after it's back between the 1% and 3%. So if you're thinking about forward pricing, forward setting, think about lower inflation, not the current inflation rate. It is declining from here.
There's also been criticism from the former governor and from political parties about and the call for a need of an inquiry into the COVID economic response spending. What do you say to that?
I'm afraid that's well outside of my jurisdiction. I will note that we ourselves, as part of our 5-yearly duty, according to our legislation, we are reviewing the remit itself. That's what we aim at and what we have to have consideration of. But we're also doing our own review of the last 5 years of activity to give it more street cred, to say you can't mark your own exams. We are going out to international experts as well. They will opine on the documents. You will see all of this, and it will all be available by year end.
Stephen Wright from Dow Jones. The bank put a statement out in response to the report that was critical of central banks in general in terms of their policy making in response to the pandemic. So why did the bank issue that statement, and did that reflect that you thought criticisms in the report were justified or fair?
I think it's important that we are seen as a learning institution, which we are. I don't like it when we aren't a learning institution. We are spending an enormous amount of time being incredibly transparent about how we're adapting and evolving. I do encourage people to read directly our monetary policy statements. I know that involves 2 clicks, not just one, to what you write about it. But if you go there, you will see an enormous amount of insight into how inflation has evolved and how we see it. The note that we put out was simply to say, acknowledge it's been seen, because, by the way, almost everyone in this room contacted us at some point, so it's easy just to say once, yes, we've read it. Yes, we acknowledge there are criticisms of us and all other central banks. Yes, we are a learning institution. Yes, I do regret that people are currently experiencing the ongoing tales of COVID and current high inflation, and that we are doing our review, as I've just mentioned before. A significant challenge for any decision maker, particularly with the lags that we have, is decisions now are impacting over the next 12 months to 2 years. So it's about playing the cards that are in your hand at the time as best as you can through time.
Hi, Vandana Ban from One News.
Sure.
Paul could chat about debt, perhaps.
Yeah, sure. Look, the OCR track that we've put out already, the banks continues to forecast rising interest rates. The banks have largely factored those that into the interest rates themselves. So you may see some more fluctuation between now and then, and across different parts of the curve, reflecting also that, as outlined in our statement, there are near-term pressures around inflation, so we could expect to see a little more increase in some of those rates. But they're substantially in line with the forecasts that we've already put out there.
Yeah, I'll just add that debt to income It's still looking reasonably. Household balance sheets overall are still in pretty good shape. We're well aware that inflation and higher interest rates are starting to put pressure on at the margin, but overall we see household balance sheets as in good shape. So debt to income is still looking pretty reasonable given what we've come through.
Also, just on wages, we know that wages are increasing, but also today we know that the gender pay gap has also slightly increased. What's driving that?
From my understanding of the day-to-day and the excitement of living in real time, is that a big part of what we saw around there is increased hours worked. So hourly pay has remained broadly, as we've talked about. Hours worked have increased, which highlights the stressed labour market, people working longer, people in demand for longer. And I believe it's some of the hours worked that has mostly helped close that ongoing gender gap. Just on and sorry Tom, just to hold you up, just on the stress levels that are out there amongst households, I will remind people that the banks have and continue to tell us have stress tested all of their customers' financial capabilities to manage interest rates well within the range we are talking about at present. So people need to stay close to their banks and they should be managed through. But there will be belt tightening.
Do you predict wages to keep going up?
For us, there is underlying wage pressure. That is a natural reflection of the scarcity of labour. It's more so in some sectors than others. But our forecasts highlight how we anticipate demand to be slowing, and over time that's going to take the heat off the labour market. So, that's, again, when you're thinking about price setting, wage setting, it's 12 months ahead that most matters, not looking in the rear vision mirror. And 12 months ahead is lower inflation pressures. Sorry, Tom.
Good afternoon, Tom Pulastraka from Stuff. The review that you've just mentioned of monetary policy over the last 5 years, I assume that's different from the remit review that's taking place. Can I just check, when did you decide to conduct that new review? Was that subsequent to the criticisms made by Graham Wheeler?
No, we're honest Johnnies. You should know that, Tom. We are the most transparent central bank internationally. We offered that up free of charge in advance of recent statements. There's two legs to it. The first one is the remit itself, and part of that is a review of our monetary policy actions over the last 5 years. So that was announced publicly quite some time ago. I know it's confusing because a review of monetary policy and a monetary policy review sound remarkably the same.
Okay, so that review of monetary policy over the past 5 years is part of that remit review.
Are we going to issue them separately so that people can have clear minds and focus? Because, the first part that we'll put out is a review of our monetary policy activities. We hope to have that out in full public glory before year end. And the second part would be our recommendations to the Minister on any changes, if any, to the monetary policy remit. That second leg will be in the new year. First or second quarter.
Last question on that. What international experts have you decided to go out to?
We've got an Australian expert and a Canadian expert. Do I check? Are they allowed to be named public? I've got no idea.
Yeah, we have spoken with both of them. So
they know, that's good.
Yes, they do. Larry Shremby, who is the previous Deputy Governor of the Bank of Canada, and Warwick McKibben from ANU in Australia.
The McKibben family are very busy, actually. It's his partner who is doing the review of the RBA, the Reserve Bank of Australia. So.
Rebecca Howard from Business Desk. I had two questions. It seems that one of the things that you mentioned that might protect us from falling into recession is inbound tourism. And given that the whole world is basically in the same boat, is there a risk that we don't actually see much inbound tourism because other countries go into recession and therefore people don't have money to spend on holidays in New Zealand? And the other question I had was around the neutral. And you spoke a little bit about doing some work on where you might see the neutral rate. Can you give us some color on that?
Yeah. You want to chat about tourism, Adam? Yeah,
sure. So, I mean, that risk definitely exists. What we're expecting is not a full normalisation of tourism, but sort of a gradual improvement, and for that to have, given the sector was largely shut off, to have quite a big impact on growth for a few quarters. And then, sorry, what was the second part of the question?
Rebecca?
I just wanted a little bit more clear.
Oh, neutral.
Neutral.
Yeah, sure. So, I mean, we've published our usual suite, and we have those analytical measures pointing to somewhere around 2, but with that big range around neutral. What we are seeing is some of those market measures, so measures of longer-term interest rates, begin to pick up. And so really what we're asking is just for a bit more detail, a dive into what are the drivers of neutral likely to be over the next few years, and then what does that mean for monetary policy?
It's, remind the audience, it's a great unknown. We've said, we have this working assumption too, but it's an assumption that we need to continuously refresh. Globally, you're seeing this incredible demographic shift. A lot of long-term factors that are putting upward pressure on what you would consider a neutral interest rate. So again, it's just regular business and us being cautious with our monetary policy stance. So I'd hate to think we're slowing the economy, but we're not doing as much work as what we assumed.
Governor, it's Ben McKay from Australian Associated Press. I clicked twice and I'm reading the statement. I haven't got to it all yet because I had to watch the Ian Foster press conference. So apologies if you've covered it off. But did you get close to a 75 basis point rise to get close to the...
Yeah, thank you for the question. And no, we didn't. Basis point moves we've made have been very orderly, well signalled and sufficient for us to achieve what we're after, by year end really. We obviously observed many other central banks around the world using the 75. In fact, I think the Bank of Canada did 100 basis points. But that's about starting from lower levels and starting later on this monetary cycle.
Can I also ask whether you've decided whether you'll be seeking reappointment next year?
No, I don't think that's something we should talk about.
Why?
Because I don't make that appointment.
But you decide whether you want to.
Yeah, and I don't want to talk about it, so that's why.
Fair enough.
So you don't know if you want to be reappointed?
I don't want to talk about it. Any other questions floating around?
Governor, Bernard Hickey here from the Kaka and Interest.co.nz.
Oh, there is.
There's some discussion about the effect of the expected 16% fall in house prices from the peak to the trough and its effect on consumer spending. What can you tell us about how that has gone and how it might go, given the 16% is a bigger fall than we've seen previously?
Yeah, so I think we even have slightly more than 16% actually from peak to trough, but we say circa 20% would be.
Depends if it's monthly or quarterly.
Monthly, quarterly, peak, trough, so on and so forth. Just as on the way up, perceived wealth gave people a kick in their steps and they shopped. We have made the same assumption on the way down that some of the perceived wealth, mark-to-market wealth, is no longer there, that will curtail the propensity to consume. Through all of this, though, employment levels remain very high. We've talked about household incomes and nominal wages, but that wealth impact is on the downward side, helping constrain consumer spending, which is what we need.
So how much more of a wealth impact becomes a concern for the bank if prices do fall more than the...
We've spent a lot of time talking, and I know there's some really good material coming out, note the veiled ad for next wee while, around the housing market, its role in monetary policy, what drives it. On the way through, I'll note a couple of things. One is that we believe house prices are now far closer to a level we would consider sustainable. So, it's coming back to a more sustainable level from being at a very high unsustainable level. So that is a good thing. It removes financial stability risks, and we are pleased with that. On the way through, we don't have an estimate or a target otherwise on the way through. But, we've been saying to many people, think very hard before making significant, large lifetime purchases such as a home.
Janae Tibshirani from The Herald. Governor, in the statement, the bank talks about how international inflationary pressures might be sort of dissipating a little bit in some areas, but then it still forecasts higher inflation and a higher OCR track than in May. Can you talk through some of the drivers of that more persistent domestic inflation and what's changed from May to now?
Yeah, great question, Janae. And it's the flip side of what we've been living on the upside. Huge imported direct costs from global inflation can add a lot of noise to measured headline CPI inflation. Underlying it has been this slow, deliberate creep in domestic price pressures. Paul, do you want to chat about the kind of components to it?
Janae, for the question. First of all, in terms of differences between the May statement and the August statement, we've got higher wage growth in there. That's at the margin inflationary. Also, fiscal policy is supporting consumption with a very minor impact from the cost of living payment. We've already talked about tourism recovering, but there's signs of sort of supply constraints in that industry, beds, workers and planes, which could be inflationary. And of course, all that feeds into expectations, which sort of pushes it out into the forecast horizon. And internationally, as you said, there's some signs of oil prices coming off and the like, but it's still a very inflationary environment out there with tight labour markets, and of course the war in Ukraine has made none of this easier.
And I'd refer people, I think it's chapter 3 in our document. There's a beautiful figure there that ranks New Zealand's inflation globally, and you can see we're going down the ranks. That's good. That's in the good direction. A lot of countries are still experiencing the rising component of their inflation and their monetary policy. So, signals different starting points. Some of the biggest international differences has been really just construction costs, food costs and energy costs and how big a component that is in various countries' CPI inflation. I was taken by the RBA's construct, I think 20% inflation in the construction sector, which has a similar weight to us. It's a global phenomenon, these pressures.
Similar dynamics across the world.
Thank you. And just on another issue, I note in the statement in the introductory remarks, you talk a bit about the Funding for Lending program and the LSAP and the fact that those bank, their settlement accounts with the Reserve Bank are quite inflated currently due to those programs. Just wondering why in the statement you haven't provided some analysis of costs of those programs. I know there's been some commentary from people around that.
Holistic way of measuring the net expected risk-adjusted return from the activities we've been taken. I've seen a lot of narrow mark-to-market positions for the Crown balance sheet. Whilst that is interesting for Crown accountants, it's missing the point around what that activity has done. Within this document, the record of the meeting, we did take a lot of time and discussion to really highlight the fact that very high settlement counter balances, i.e. these are where the commercial banks bank with us with their cash, their settlement counts balances are very high at the moment. So in that sense, saying, well, there's a lot of liquidity. But we're adamant that is not at all damaging the effectiveness of the monetary policy channel. In other words, the official cash rate is working as expected, and we can see that because of the credit stats we can observe and all of the other constraints that are on banks' ability to create that money multiplier effect that some recent authors have shown angst about. That is liquidity, funding, actual demand. There is a plethora of constraints that mean that settlement cash balance is interesting, but not the causation or challenge that is here. We will talk a lot more about that very soon to, I hope, demystify some of this area. I know it's been complicated for people.
Just one more question. The LSAT program, I think the last forecast done around the impact of that program put it at shaving 50 to 100 basis points off interest rates or something to that effect. That forecast was done a year or two ago, I think. Do you have an update on what you think the actual impact of the LSAT was?
Yeah, so we revalidated that recently as part of our ongoing assessment, and that range still stands.
And of course, all of this is part of our review that we're undertaking at the moment.
So it helped, but it's counted by the official cash rate.
Yeah.
Lucy from Reuters. First question, you talked a little bit about house prices maybe falling circa 20%. We were talking 15% when we were here 3 months ago. What's changed in the last 3 months that has seen house prices fall?
Again, sorry, I was trying to find out who.
Sorry.
It's hard when you can't see whose mouth's moving. Yeah. So actual house prices are coming off much quicker. We remain equally as competent as we always have at projecting house prices. We can tell you where they are relative to something that we are confident around, our sustainable measure, and then we're observing it like the rest of you. And so we've seen prices go from being well north of sustainable to being within the zone of sustainable. So that's really it. What's driving lower house prices? Risk aversion. People are going, well, perhaps we overdid this.
Monetary policy.
Your OCR profile has it at 4% by March. This suggests a 50 basis point hike at the next meeting. Is that right?
We've got 2 meetings between now and calendar year end, and another one in February. We will never predetermine what we're going to do because why would you? Options are valuable, so we retain our optionality. But our view is that sitting around that 4% official cash rate level buys the Monetary Policy Committee right now significant comfort that we would have done enough to see inflation back to our remit. Now, all of that is conditional on whatever else is going to happen next.
Dairy prices have come off about 27-30% this year. How much of a concern is that for you and its impact on the economy?
You want to chat about the terms of trade, Paul or Adam?
Yeah, sure. I mean, they've come off significantly from a very high base. It's important to say. So I think from on the farm perspective, they're still pretty good compared to history. We do see the terms of trade likewise coming off from a very high level because the price for our export commodities, as you say, are coming off, and we just think the prices of our imports are also likely to ease, but not to the same extent. So negative terms of trade.
We have been an unbelievable beneficiary of food prices globally, and we all know the temporary nature of some of that reasons that they've been so high, and by definition we don't expect them to stay there that high. But we are very pleased to see significant rural success over the last couple of years and financial success with it. Their balance sheets are looking a lot better than when I stood up here 3 years ago.
Giles Blackwood from Radio New Zealand. Just picking up on the point made by Janae and comments made by Paul, do you now regard domestic, should we say, non-tradables as the greater impulse driver of CPI?
Yes, absolutely. That's the bit that we get most purchase on with our New Zealand dollar interest rates, most impacts on New Zealand dollar spending. So that's that homegrown component of inflation. That's the stuff that we can get at over a 12, 18 month period horizon. And that is the bit that has been growing. It's too high. Measures between 4 and 6%, different measures of core underlying inflation, and we need to get on top of that. Those are construction costs, food costs, energy costs are all, and labour costs are all embedded in that. So that's the mahi we have to do. That's the mountain we have to climb.
And just following on from that, your projections suggest a 4% peak for the OCR. And staying there until late 2024. As you will have noted, clearly some market pricing is anticipating cuts as early as H2 next year. Are they getting too far ahead of themselves?
Well, you know, as you and I have joked many times before, markets will pick 15 of our next 2 changes, and that's what makes a market. So, you know, those who think they can go long or go short, knock yourselves out. We will play the data we see at the time.
And is that going to be, in fact, the basis, the criterion for when you've hit that sort of 4% peak? Are you data dependent thereon?
I would love to be in a position where we can return to our natural habitat of watching, worrying and waiting. And, you know, to do that, we think an official cash rate around 4% is unambiguously above a neutral rate and of sufficient constraint to meet our full mandate. Remember, it's inflation 1 to 3% without unnecessary instability in output, interest rates and the exchange rate. So it sees inflation come back into that 1 to 3 zone in a beautiful, orderly fashion.
Hi, Ainsley Thompson from Bloomberg again. You spoke about people buying homes having to be careful about the obligation they're making, which is understandable. But how much concern is there about the people who bought last year at the height of the market who are likely to be highly indebted in their ability to meet their obligations?
Yeah, so first and foremost, we aren't heartless. You know, we were making as much noise as we possibly could to people over the last 2 years about think wisely. There's no such thing as a one-way bet when taking risk. So, you know, that said, the good news is we made so much noise, particularly with commercial banks themselves, to say, are you behaving responsibly? Are you truly stress testing these people's incomes across a broad range of interest rates? And I can say we know from our own supervision activity that the interest rate levels we're looking at the moment are survivable, but will mean for recent buyers some belt tightening. You know, they have bought at the top of a market. We always know that the hardest part to bridge in buying a home is the actual deposit. So they've taken on big deposits and they now need to sit it out. So, but stay close with your banks. If the bank's done their jobs, as they have said, kapai.
Stephen from Dow Jones. Given the signs that inflation pressures are starting to recede and also the signs that there is a slowdown coming in the economy, do you think it's more likely that from now on, or are the chances of, are 25 basis point increases more likely or more prudent than 50 basis point increases from now on? Thank you.
Yeah, I certainly can't prejudge the Monetary Policy Committee who's sitting around there. That will be, dependent on each time we're at the table. What's the direction? What's the pace? So, we've put our best foot forward at the moment from those projections. And again, what's going to happen next?
Might I just add that the inflation projection that you see in the document is consistent with the track for the OCR that's in the document. So it's not falling all by itself over the forecast horizon.
Yeah, I think that endogeneity is really important to push home. The reason we're forecasting lower inflation is because we have the interest rates where they are.
Governor, on the government stimulus to the economy, you mention in the statement that the current government spending track is assumed to go in line with the budget forecasts, but then you make the comment any government expenditure above this is likely to require higher interest rates in response. Was this a particular decision to give a quiet warning to the government not to expand too much more than they already are in the next year or two?
No, we're adamantly not the fiscal gurus of Aotearoa New Zealand. We're monetary policy. We're just stating a bold fact that if spending's higher than otherwise, it means everything else changes as well. I will note, that inflation really is a thief in the pocket. It's a thief for government as well. A lot of their nominal expenditure is literally just to maintain the real level of services they're delivering. So the quicker we get on top of inflation, the better fiscal policy is able to get on and do its job. The quicker that businesses stabilise their pricing expectations and people calm down on their wage expectations, the more likely is we will have a recession-free period and plenty of employment.
The monetary policy statement also talks about the growth in construction costs as the non-tradable, one of the big non-tradable drivers. There are some concerns that profit margins in the sector have been quite strong, and Fletcher Building reported significant profit growth today. Are you concerned at all that some of the inflation pressures are coming from companies with strong market positions expanding their profit margins?
Without doubt, the construction sector has been one of the significant core components of the rising inflation pressure we're seeing in New Zealand. And at the highest level is something like 50,000 new consents. That's about 15,000, if not more, consents ahead of what the capacity of our economy is to actually produce. So everyone is rushed to build at the same time, and that is leading to incredible pricing pressure, and you're talking about some of the outcomes we can see. It's a truism to say more suppliers, more competition, more price advantages, but the blunt fact is consents are well ahead of the ability to deliver. We also put a warning in there that beyond what is currently in the pipeline, which is proving very hard to swallow, there's a falling level of orders ahead. So in 12, 18 months ahead, whilst they're making hay as the sun shines, they're going to have to be thinking about retaining their customers, about spreading that work a bit further out, rather than the traditional boom-bust behaviour that is too often seen.
What evidence does the Reserve Bank need to stop... Oh, sorry, over here. What evidence does the Reserve Bank need to stop increasing the official cash rate?
Pretty well what you see in that document. If you see the economy panning out broadly as our projections, and that's a slowing in consumer spending, continued easing in that medium-term inflation expectations, actual headline CPI inflation coming off is a good thing. So it's really just observing a vast array of data that shows that we are broadly on track with the projection as outlined. The projection as outlined is not fun. It's one where consumer spending is flat in real terms. We're not used to that. We like to spend well beyond that. So, it's saying there's no technical recession, but there is a significant slowing that is needed to get inflation back in its box.
Yes, Adrian, Eric Frickberg from Good Returns. Bernard took my question, really, but I'd just like to put it again that in terms of things like construction costs, you can't necessarily control them, but government spending is something that can be decided by government policy. So is there not perhaps a need for focus on this, even if you're not the fiscal guru?
I am adamant that the government is well aware of the inflation problems and that they are well aware of what their fiscal spending does and doesn't imply for the interest rates. I would put a caution there that government can't and shouldn't stop all of its spending. The vast bulk of it is actually just automatic stabilisers as people come in and out of health or illness or work or unemployment. These are the standard settings that will continue on, and they are impacted by inflation levels, particularly if they're indexed to nominal wages on the way through. So governments will have to continue doing what they're doing. But more competition across almost all of New Zealand's large sectors would be wonderful.
Governor, you mentioned that the bank is a learning institution. What learnings can we take from the last 3 years?
I want to come back in a fulsome document that has been internationally reviewed, and that all of the makings of the ingredients and the final cake you can all look at. So those are the important parts. I would say the constraint on labour supply globally is phenomenal. There's not a single country. I've recently back from a meeting with central bank governors from the rest of the world. You could have taken the name of the country out of any of the presentations. They were identical. Labour shortages, energy and construction costs. It's a global phenomenon, given this extreme pandemic event, with being iced on with Putin's war in Ukraine. So it's a wonderful combo of inflationary environments. And probably one to go. Yeah.
Just following up on that labour issue, others have said we need to open the migration taps to take some pressure off wages. What's the Reserve Bank's view? Because there's not much discussion about migration in this.
Yeah, so we normally do. We talked a lot about migration, I think, in the previous MPS. This one, we didn't have much more to say. We see net migration turning positive again by the end of this year, going into next. Is that right, Adam?
Yep. Yeah. So essentially a turnaround from about now up to levels nowhere near the past peaks that we've seen. So something more around the sort of 20-year average of inflows. Yeah.
Well, labour is the number one scarce resource, so sourcing labour is good. Remember that my previous comment, every country is doing this at the moment. So there is a global competition for labour, and us opening our borders is get in the queue by the sounds of it. So.
Stephen from Dow Jones again. What toll would you say has been criticised by your predecessors taken on you? And given the whole global situation of the past couple of years, do you feel that some of this criticism has scapegoated you as an individual and the Reserve Bank as an institution?
Yeah. At the personal level, we expect to receive plenty of insight and feedback and criticism. That's party to the game. It was timely, all the recent stuff, because it is useful to feed into our monetary policy review, and so that's the action. I would make one statement that criticism's nice. Retaining integrity is really important to us here at the bank, and I know that the Monetary Policy Committee sleeps straight at night. We are following our remit as best as possible.
Janae from the Herald again. How confident, or how can the Reserve Bank explain that it has a social licence to operate? It's obviously very important for monetary policy to be effective, just in light of all these criticisms and the sorts of people, the calibre of people that they're coming from. Reputation is critical to maintain our role, our integrity. Cool. Just before we all go, thank you very much for attending. And I know there was a far more important 2:30 press conference that some of you obviously saw, but I do just want to provide an advertisement for our monetary policy challenge. This is going out to all year 12 and 13 secondary school students. We are doing and anyone can log in and watch. Our WISE staff will be doing a video introduction and asking students questions, I think on August 2-5. And then the students are off to have their own monetary policy committees and report back. So it's a way in which our education system can get more involved in a more user-friendly fashion, and I hope to read about it in all of your leading articles and magazines on the way through. Feel free to join it if you have school children as well, of course. Kia ora, thank you very much, and see you soon. Thank you.